Hello everyone, let me introduce myself. I am Nurananda NPM 234122025. Here I will explain material about bank reconciliation. Let's watch the video. Bank reconciliation is a process carried out to match the cash balance according to the company's accounting records with the cash balance according to the bank report. The main purpose of bank reconciliation is to ensure that a company's financial records and bank statements are accurate and consistent. Balance differences can occur due to unrecorded transactions, error in recording, differences in recording time between companies and banks. Bank reconciliation has several important objectives, including ensure cash balance accuracy, avoid recording errors in internal bookkeeping, detect errors or fraud, identify suspicious or incorrectly recorded transactions, monitor cash flow appropriately, know the actual cash position for better decision-making, ensure all transactions are recorded, ensure that every receipt and payment is recorded by both parties, namely the company and the bank. The following are the steps that can be taken in the bank reconciliation process. Take bank statements and cash balances according to company records. Match transactions one by one. Check for deposits, checks, transfers, or bank charges contained in both records. Note any differences found, for example, deposits in transit, deposits that have been recorded by the company but have not yet been recorded at the bank. Uncashed check, a check that has been issued but has not yet been cashed by the recipient. Bank fees, bank service deductions or fees that have not been recorded by the company. Bank interest or income, interest on bank balances that may not have been recorded on the books. Correct or adjust differences. Make adjusting journal entries if necessary to record the differences. Compare again. Make sure the balance between company records and bank statements is consistent. Okay, here I have an example of a question about bank reconciliation from PT Ananda Malfoy. Let's look at it. On November 30th, 2024, there is a difference between cash balance according to company books, or $26,000, cash balance according to bank statement, IDR $24,000. After carrying out the reconciliation, several transactions were found that caused the differences. Check number 321 worth IDR $3,000 has been issued by the company but has not been disbursed by the recipient. The bank recorded a service fee of IDR $400,000, but it has not been recorded in the company's books. A cash deposit of IDR $5,000 has been made, but has not been recorded in the bank statement. The automatic loan interest payment of IDR $1,500,000 was recorded by the bank, but not yet recorded by the company. An outgoing transfer of $2,000 was mistakenly recorded twice in the company's books. Conclusion 1. The final cash balance according to the company's books is IDR $26,100,000, while the final balance on the bank statement is IDR $26,000. 2. The difference of IDR $100,000 may come from a small transaction that has not been recorded by either party or due to an administrative error. 3. Bank reconciliation helps companies ensure consistency and accuracy between internal and external records, as well as detect potential errors or missed transactions. In this table, we see a bank reconciliation report that shows how the cash balance according to the company's books and bank statements is adjusted. This reconciliation is important to reconcile the differences between the two records and ensure accurate financial statements. Let's take a closer look at each customization component. Beginning balance column company. Book, RP $26,000. Company book adjustments plus outgoing transfer correction. $2,000. The company incorrectly recorded outgoing transfers twice. This correction increases the cash balance in the company's books. After correction, the temporary balance becomes IDR $28,000. Bank service fees, right, $400,000. Banks have cut service fees, but the company has not recorded them. After recording these costs, the balance becomes IDR $27,600. Loan interest, or $1,500,000. The bank also debits the company's account for loan interest payments. After recording, the company's final book balance is IDR 26,100,000. Bank statement adjustments, plus deposit in transit, IDR 5,000,000. This deposit has been recorded by the company, but the bank has not recorded it because the deposit was made on the last day of November. Check number 321, not yet disbursed, for $3,000,000. The company had issued this check, but the recipient had not cashed it until November 30th. The bank has not reduced the balance because the check is still in transit. Okay, that's all the explanation of this material, and it can be concluded that bank reconciliation is an important step in ensuring the accuracy of financial records and avoiding cash flow problems. This process not only identifies errors or omissions, but also helps companies better manage cash and detect suspicious activity. Carrying out routine reconciliation is highly recommended to maintain the company's financial credibility. Okay, see you in the next video. Bye-bye.